War was escalating. Oil was climbing. China was buying gold and silver physically, frantically, off the shelves. Every signal, every data point, every historical pattern said one thing: silver should have gone up. And then, in just a few minutes, it dropped. $94, $91, $88. Someone knew something. And what they knew could change everything you thought you understood about money. Welcome to Financial Crisis Explained, the one place where the numbers tell the truth, even when no one else will. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't throw away a newspaper that predicted the market crash before it happened. So don't scroll past that subscribe button either. One click, that's all. Just like saving an important document, you do it before you need it. And we'd love to know, where in the world are you watching this from right now? Drop your city, your country, in the comments below, because what's happening in silver today affects every corner of this planet, and we want to know exactly where you're standing. When it does, it was an ordinary Monday morning for most people. Coffee, emails, morning routines. But for anyone watching the silver market at that precise moment, it was anything but ordinary. At 9:47 a.m. Eastern Time, silver was trading at $94 per ounce. The number sat there, firm, confident, almost defiant, as if the market itself was daring someone to challenge it. And then, someone did. Within minutes, not hours, not days, minutes, silver collapsed to 88, $6. Gone. In the time it takes to finish a cup of coffee, billions of dollars in silver value simply evaporated. Now here is where this story becomes more than just a price chart anomaly, because on that exact same morning, the very same hours that silver was crashing, three of the most powerful bullish forces in commodity market history were all firing simultaneously. War was escalating in two separate geopolitical corridors, not rumors of war, not diplomatic tensions, active, documented escalation. The kind that historically sends investors running toward precious metals as a shelter from uncertainty. Oil prices were climbing. Energy costs were rising sharply, a direct signal of inflation pressure building beneath the surface of the global economy. And when inflation rises, silver has historically followed. Every serious student of economic history understands this relationship. It is not a theory. It is a pattern, repeated across decades, across recessions, across currency collapses. And China was not merely buying silver. China was in a full-scale physical precious metals frenzy. Major e-commerce platforms across the country had already repriced gold equivalents to levels that made Western analysts pause mid-sentence. Physical gold and silver bars were disappearing from store shelves. Not slowing, not declining. Disappearing. Retailers were left offering only decorative pieces, ceremonial, ornamental items, because investment-grade bars simply no longer existed in sufficient supply to meet demand. Three forces, all pointing in the same direction, all screaming, in the language of data, of history, of fundamental economics, that silver should rise, and silver fell. This is the moment where most financial commentary stops asking questions. Most analysts will file this under market volatility. They will reference profit-taking. They will mention technical resistance levels. They will produce charts with lines and arrows and sophisticated-sounding explanations that ultimately say very little. But Financial Crisis Explained does not stop at the surface, because the question that serious decision makers, business owners, entrepreneurs, anyone building or protecting wealth in this economic environment must ask is not simply what happened. The question is, who made it happen, and why? To understand the answer, one must first understand a concept that mainstream financial media consistently underexplains: the difference between paper silver and physical silver. They share a name, they share a price ticker, but they do not share the same reality. Paper silver, traded primarily through futures contracts on exchanges like COMEX, represents promises, contracts, obligations to deliver silver at a future date. The volume of paper silver traded daily dwarfs the actual physical silver that exists on this planet. Some estimates suggest that for every single ounce of physical silver in existence, hundreds of paper ounces are traded. This is not a conspiracy. It is a documented structural feature of commodity markets. And it means one thing with profound implications for anyone watching Monday morning's price action. The price of silver is not purely determined by how much silver exists, or how desperately China needs it, or how dangerous the world has become. It is determined, at least in the short term, by whoever controls the largest positions in the paper market. And on Monday morning, someone with an extraordinarily large paper position made a decision. That decision sent silver from $94 to $88 in minutes. It confused retail investors. It rattled emerging market buyers. It created headlines that asked the wrong questions. But for those who understand how markets truly function beneath the surface, It was not confusing at all. It was a signal, and the signal was just beginning to speak. War, oil, and Chinese demand. The bullish case. Examined, most people look at a price chart and see a number. Serious analysts look at the same chart and see a battlefield. And on the morning, silver dropped from $94 to $88. The battlefield was already crowded with forces. Powerful, undeniable, historically validated forces, all pushing toward one inevitable conclusion. Higher prices. The fact that prices went lower anyway is precisely what makes this moment worth studying. Force 1. War. There's an old saying among commodity traders that has survived every market cycle, every recession, every technological revolution in finance. When the guns fire, gold and silver rise. This is not sentiment. This is not folklore. This is documented economic behavior repeated across more than a century of market data. When the Gulf War began in 1990, silver surged. When the September 11th attacks fractured global confidence in 2001, precious metals climbed. When Russia entered Ukraine in 2022, gold broke records within days. The pattern exists for a precise reason. War destroys confidence in paper currency. Governments facing military conflicts spend beyond their means, printing money, issuing debt, inflating their way through crisis. Investors who understand this dynamic do not wait for inflation to arrive. They position before it does. And historically, the instrument they reach for, first, is silver and gold. On the morning of silver's collapse, active geopolitical escalation was not a background story. It was front page across every major financial publication. Two separate conflict corridors were intensifying simultaneously. Military budgets were expanding. Supply chains, critical to global manufacturing, many of which depend heavily on silver for electronics, defense components, and industrial applications, were under documented stress. Every variable said the same thing. Demand for silver should be rising. The market said otherwise. Force 2. Oil is not merely an energy commodity. Oil is the circulatory system of the global economy. When oil prices rise, the cost of everything attached to the physical world rises with it. Transportation, manufacturing, agriculture, construction. And silver mining is no exception. Extracting silver from the earth requires diesel-powered machinery, energy-intensive processing, and complex logistics chains that stretch across continents. When oil becomes more expensive, silver becomes more expensive to produce. When production costs rise, the floor price of any commodity rises with it, but the relationship between oil and silver runs deeper than production economics. Rising oil prices are one of the most reliable leading indicators of broad inflationary pressure. And inflation, sustained structural inflation, is the single environment in which silver has historically performed with the greatest consistency, not just as an investment, as a store of value, as a mechanism for preserving purchasing power when paper currency begins its slow, quiet erosion. On the morning in question, oil was not merely elevated, it was climbing with the kind of momentum that suggests structural drivers, not temporary supply disruptions. Analysts tracking energy markets were already revising their forecasts upward. The inflation signal was loud. Silver's price ignored it entirely. Force 3. China. And then there was China. If the war signal was loud and the oil signal was clear, the China signal was nothing short of deafening. Understand what was happening on the ground. Not in futures markets, not in financial terminals, but in actual physical locations across the world's second largest economy. China's largest e-commerce platforms had already repriced precious metals to levels that exceeded Western spot prices by margins that market veterans described as extraordinary. But repricing was only the beginning of the story. Physical silver and gold bars, investment-grade, deliverable, tangible metal, were selling out entirely across major retail outlets, not moving slowly, not experiencing reduced inventory. Selling out. Stores pivoted to offering only decorative and ceremonial pieces because investment product simply ceased to exist on their shelves. This is not speculative demand. This is not paper contract activity. This is millions of Chinese citizens and institutions making a simultaneous, physical, irreversible decision to convert paper wealth into hard assets. When a population of that scale moves in one direction with that kind of urgency, history suggests the rest of the world eventually follows. Three forces. Independently verified, historically validated, fundamentally aligned. War said, buy silver. Oil said, buy silver. China was already buying silver, physically, frantically, without hesitation, and yet the price fell, which means only one thing. Someone on the other side of this trade was more powerful than war, oil, and Chinese demand combined. Understanding who that someone is where this story gets genuinely dangerous. Who sells into strength, and why. There is a moment in every great market mystery where the obvious explanation runs out of road. where the data stops making surface-level sense, where the fundamentals point one direction so clearly, so convincingly, so historically, that the only rational conclusion is that something else is operating, something beneath the visible market, something that doesn't appear on retail trading screens, something that most financial educators will never explain to you, not because the information is secret, but because understanding it requires dismantling a belief that most people hold without even realizing they hold it. That belief is this: prices reflect reality. They don't. Not always, not in the short term, and certainly not in a market where paper dominates physical by a ratio that would make any reasonable person stop and question everything they thought they knew about commodity pricing. Monday morning's silver drop was not an accident. It was architecture. The mechanics of paper dominance. Return for a moment to what was established in Part 1. COMEX, the Chicago Mercantile Exchange's commodity trading division, is the primary venue through which silver prices are officially discovered in the Western financial world. It is the number that appears on Bloomberg terminals. It is the number that retail investors track. It is the number that becomes the headline. But COMEX trades paper silver, contracts, promises, obligations. And the volume of those contracts on any given trading day can exceed the entire annual global production of physical silver. Not by a small margin, by multiples that require a pause to fully absorb. For every ounce of physical silver mined, refined, and delivered anywhere on Earth in a given year, the paper market trades that same ounce, on paper, dozens, sometimes hundreds of times over. This structure does not exist by accident. It exists because it serves a specific function for a specific class of market participant. Who sells into strength? When three of the most powerful bullish signals in commodity market history are firing simultaneously, war, oil, rising physical demand, the rational expectation is that institutional money flows into silver, and some of it does. But there's another class of institution whose interest runs in precisely the opposite direction. And their tools are not retail brokerage accounts. Their tools are concentrated futures positions, large enough to move price, held long enough to trigger cascading sell orders from algorithmic trading systems, and executed at moments specifically chosen for maximum impact. Monday morning was one of those moments. As Western markets opened, still absorbing weekend news of geopolitical escalation and Chinese physical demand, silver briefly surged toward $94. Momentum was building. Retail sentiment was turning bullish. Social media commentary was erupting with predictions of a historic breakout. And then, with the precision of a controlled demolition, the selling began. Not gradual, not reactive, coordinated. Large paper positions, entered in rapid succession, flooded the futures market with synthetic supply. Algorithmic trading systems, programmed to respond to sudden downward price pressure, triggered automatic sell orders. Stop losses activated across thousands of retail positions simultaneously. Each triggered stop became another sell order. Each sell order pushed price lower. Each lower price triggered another wave of stops. In the language of market structure, this is called a stop hunt. In plain language, it is the financial equivalent of someone shouting fire in a crowded theater, watching the stampede, and quietly collecting the chairs everyone left behind. The pattern has a history. Here is what makes Monday morning's action not merely interesting, but strategically important for anyone building or protecting wealth. This has happened before. May 2011, silver reached $40 per ounce, a historic high driven by genuine physical demand, inflation fears, and institutional accumulation. Then, within 5 trading sessions, COMEX raised margin requirements 5 times in 8 days. The paper cost of holding silver positions became prohibitive overnight. Forced liquidations cascaded through the market. Silver lost nearly 30% in days. The fundamentals had not changed, the physical demand had not disappeared, but the paper market had spoken, and the paper market won. March. As COVID fear gripped global markets, silver collapsed alongside equities, despite being historically categorized as a safe haven asset. Physical demand at retail level was so intense that dealers across North America and Europe ran completely out of inventory. Premiums on physical silver coins reached 30%, 40%, 50% above spot price. The physical market was screaming one price. The paper market was printing another. What this means for serious decision makers. This is not a story about manipulation as a grievance. Grievance is not a strategy. This is a story about understanding the architecture of the market you're operating inside. Because only by understanding the architecture can you make decisions that are not controlled by it. The entrepreneur who understands that paper price and physical reality can diverge dramatically and historically temporarily does not panic when silver drops $6 in minutes on a morning when every fundamental signal says it should be rising. They ask a different question entirely. Not why is silver falling, But who is accumulating while everyone else is selling? Because in every documented case of paper-driven price suppression against strong physical fundamentals, the suppression eventually ends. The physical reality eventually reasserts itself, and those who understood the difference between the paper price and the physical truth, or were already positioned before the reassertion began. The invisible hand that pushed silver from $94 to $88 on Monday morning did not destroy value. It transferred it, from those who did not understand the game to those who did. The only remaining question, the one that determines which side of that transfer you stand on, is what happens next. And what happens next is where China re-enters the story, with consequences that the Western financial world is only beginning to calculate. Reading the signal behind the noise. Every market tells two stories simultaneously. The first story is loud. It runs across tickers, headlines, and trading terminals. It is the story of price, what silver closed at, what gold opened at, what the percentage move was in a single session. This is the story that most people follow. This is the story that most people react to. The second story is quiet. It moves beneath the surface. It speaks not in daily price movements, but in structural shifts, in the divergence between Eastern physical markets and Western paper prices, in the behavior of sovereign institutions that do not issue press releases, in the accumulation patterns of those who have studied every previous cycle and positioned themselves accordingly. Monday morning's silver drop from $94 to $88 was front-page news in the first story. In the second story, it was barely a footnote, because the second story, the one that actually determines where silver goes from here, began long before Monday morning, and it will continue long after the headlines move on to the next distraction. Understanding that second story is the entire purpose of this final chapter. The precedent history cannot stop repeating. There is a sequence that serious students of monetary history will recognize immediately. It begins with physical accumulation by sovereign and institutional players operating quietly, consistently, and with extraordinary patience. It continues with paper price suppression, temporary, structural, and always eventually finite. It culminates in a repricing event, sudden, dramatic, and deeply uncomfortable for anyone who is positioned on the wrong side of the divergence. The sequence has repeated across every major precious metal cycle of the last century. The 1970s, a decade of paper dollar dominance, Nixon closing the gold window in 1971, severing the last formal link between currency and physical metal. For years, gold and silver were managed, suppressed, talked down by institutional voices, with significant interest in maintaining dollar confidence. And then, between 1971 and 1980, gold rose from $35 to $850 per ounce. Silver rose from under $2 to nearly $50. The paper story said one thing for years. The physical reality eventually said something else entirely. The 2000s. Gold entered the decade below $300 per ounce, while central banks publicly sold reserves, and analysts declared precious metals irrelevant in a modern financial system. What those same analysts failed to track, or chose not to discuss, was the quiet, consistent accumulation happening in Eastern sovereign wealth funds, in private family offices across Asia and the Middle East, and in the vaults of institutions that operate on generational timelines rather than quarterly earnings cycles. By 2011, gold had reached $1,900. The pattern is not subtle, it is not hidden. It is simply ignored by those who profit from the short-term paper narrative. The China variable that changes everything. Return now to what was documented in Part 2, but extend the analysis beyond a single morning's buying frenzy. China's relationship with physical precious metals is not a reaction to current events. It is a decades-long strategic policy. The People's Bank of China has been systematically accumulating gold reserves. Officially reported accumulation that most analysts believe significantly understates actual holdings. Chinese citizens have been culturally and institutionally encouraged to hold physical precious metals as personal wealth preservation tools, and the infrastructure China has built around physical metal trading, domestic exchanges, storage facilities, e-commerce platforms that reprice in real time, suggests a nation that is preparing not for a single buying opportunity, but for a fundamental restructuring of how value is stored and transferred globally. When Chinese e-commerce platforms price gold at the equivalent of $5,474 per ounce, while Western spot sits at $5,346, that is not a temporary premium. That is a signal of structural divergence, a gap between what physical metal is worth to those who actually want to hold it and what the paper market says it is worth to those trading contracts they will never convert to physical delivery. Historically, these divergences do not persist indefinitely. They resolve. And when they resolve in the direction of physical reality, not paper fiction. The oil-silver relationship completes the picture. There is one final variable that serious decision makers must integrate into their framework before this analysis is complete. Oil's continued rise does not merely signal inflation in the abstract. It signals a specific, measurable pressure on silver supply that the paper market consistently underprices until it cannot ignore it any longer. Silver mining operations across Latin America, Central Asia, and Sub-Saharan Africa, which collectively represent a significant portion of global silver production, are facing energy cost escalations that directly compress profit margins at current price levels. When production becomes uneconomical at prevailing prices, producers slow output. When output slows against rising physical demand, the supply-demand equation shifts with a speed that paper markets are structurally slow to acknowledge. This is not a prediction. This is basic commodity economics operating on a timeline that quarterly-focused analysts consistently underestimate. The oil signal is not background noise. It is a countdown. The strategic framework for what comes next for the entrepreneur, for the business builder, for the serious decision-maker watching this, not as entertainment, but as economic intelligence. The framework distilled from everything examined across these four parts is this. Short-term paper price and long-term physical value are currently operating in different realities. The drop from $94 to $80 was a paper event. Engineered? Temporary? Structurally consistent with every previous documented instance of futures market-driven price management against strong physical fundamentals. The Chinese accumulation is a physical event. Patient, structural, consistent with a sovereign strategy that operates on a timeline measured not in trading sessions but in decades. The war escalation and oil pressure are inflationary events, building, compounding, consistent with historical environments that have always, without exception, eventually been reflected in precious metals prices. These three realities are currently diverging from the paper price. Divergences of this magnitude and this duration have, in every previous historical cycle, resolved violently and suddenly in the direction of physical truth. The question for anyone paying attention is not whether that resolution comes. History has already answered that question. The question is whether you understand what you are watching clearly enough to be positioned before it does. Because the drop from $94 to $88 was not the crisis, it was the invitation. And the ones who recognized it as an invitation rather than a warning are already 3 moves ahead of everyone still trying to explain the headline. The market has spoken in the language it always uses when something important is about to happen. Quietly, precisely, beneath the noise. The only remaining question is simple. Were you listening?